This show is intended for general purposes only, as individual situations may vary. Statements made should not be relied upon as recommendations or solicitation. When discussed, past performance is no guarantee or indication of future results. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services, member FINRA, and SIPC.
Good Sunday morning. This is Bud Hettinger. Next on News Radio 102.5 WFLA, the longest-running radio show in Central Florida, Dollars and Cents, with my good friend Joel Garris from Nelson Financial Planning. You can call him at the office this week at 407-629-6477 to schedule your free consultation to discuss your retirement plans. Or you can talk to him right now at 407-916-5400.
Well, good morning, ladies and gentlemen, and welcome to the program Dollars and Cents. My name is Joel Garris, and for the next hour, we are going to help you make sense out of all of those different things that have anything and everything to do with your dollars. So, on the program today, we've got a lot to talk about. If you listened last week, you knew that I was on the road this past week visiting some portfolio managers up in Chicago. So we've got some stuff to share with you about that. And then this past week, and I didn't even note this last week on the radio show, but this past week, we had an anniversary as a company and sent out an email letting our clients know about our anniversary and then also giving them some perspective on volatility in the markets. As we typically do every few weeks, we like to reach out to our clients and send them sort of our latest thoughts and some perspective on the headlines. And so, lo and behold, Tuesday was May 1st, which in fact was the date that our firm was started back in 1984. Started all those many years ago by my father-in-law, Jack Nelson, continued today by yours truly, Joel Garris. And so it was kind of neat to celebrate. I guess the extent of the celebration was to just mark the date, which is always good to do. So got some communication out about our anniversary this past week. And, of course, earnings continued. We'll talk about that in the program when we kind of talk about the week past and the week ahead. And, of course, we've got much to talk about based upon our trip, some interesting information that we want to share with you, starting with really the changing shape of global trade. And I think this is an interesting topic because, obviously, trade is really getting a whole lot of conversation, right? As we hear this conversation about renegotiating our current trade deals. Perhaps for many reasons, it's interesting to have this topic because the reality is that trade has changed quite a bit from what it used to be. If you think about it, previously when you talked trade, you talked about the flow of stuff, right? Physical goods. Now, increasingly, it is the flow of data and information. Well, data and information is not quite the same thing as a physical good, like a washer, dryer, or refrigerator. If you look at the estimates of how much data traffic across the globe is expected to increase just in the next 5 years, it's expected to increase by a total of 4 times. The numbers that I'm looking at measure terabits per second, whatever a terabit is. But currently, terabits per second, that global cross-border exchange of information, is measured at 952 for the year 2018. By the year 2022, so that's actually just 4 years away, it's expected to rise to 4,161. So when you measure data flow, you measure it as the amount of information that is flowing over the bandwidth that is the internet and those types of electronic communications. If you look at the increase in data traffic, 5 years ago, for example, it was at a level that was 214 terabits per second. Now it's 952, so that's already gone up a factor of 4 just in the past 4 years. It's expected to rise another factor of 4. So it really is a changed world in terms of when we think of the conversation about global trade. It's no longer physical goods. It's really more the flow of data and information. And if you also think of it in terms of types of infrastructure, right? So if you've got more physical goods, right, then you have a much greater focus on transportation infrastructure, right? So that these trucks and trains and what have you can deliver the physical good. Now, with the increasing flow of data, that you're really looking at more the digital infrastructure, optic fiber, things like that are really more the focus on the digital infrastructure. So it's certainly very different than what we've seen in the past. And then, of course, if as you're looking at data, that's a different animal, right? That's not somebody that is putting some bolts in a washer or welding something. It's a very different labor pool that involves a lot more automation. And so that then changes those baseline labor costs and certainly does affect that global trade balance, because you no longer need the human being, and for that matter, you no longer need the cheap human labor, because ultimately automation does a lot more of that than it used to. So no longer as a company, because we're moving away from the physical good more to data in terms of the what actually is getting moved around globally. Then, as a result of automation, you don't need the bodies, if you will. So that also changes your options as to where you ultimately place your factory, right? Because in the past it was, I'm going to look for cheap labor, so the production of the physical good was close to that lower cost labor. That's the whole argument with China, and you get all these companies that are making the stuff in China because the Chinese workforce, those production lines are cheaper, a lower cost production force. But now with the advent more and more of automation, more and more that the focus on global trade is really more about data, at the end of the day, then that gives you the opportunity to have those production lines closer to where those end markets are. So it's very different. These are some really significant shifting trends, if you will, in global trade that have some pretty broad implications beyond just the conversation you're hearing out of Washington about, we're going to renegotiate the trade deals and things like that. The reality is global trade itself is changing, and we need to be aware of where those opportunities are from an investing perspective, because it's no longer the delivery of physical goods. It's no longer we've got to build infrastructure, transportation infrastructure, because it's more of a digital infrastructure. There's no longer a need to chase cheap labor because of automation, which allows you to do more production lines closer to where the end market actually is. Now, in terms of China and those roles, obviously in the past, the Western economies have sort of dominated trade, and certainly China is seeking to be a much greater force in global trade itself. So that's obviously a very different dynamic. It's also a different dynamic for businesses as well, whereby with physical products and transportation infrastructure, you had a much greater focus on industrial and consumer-oriented companies. Now you really have to be more of a global company with knowledge of this overall economy in order to take advantage of where the automation, where the production lines are, in order to be closer to your end user. So really, as we listen to this conversation out of Washington about global trade, what we also have to realize is that global trade itself is changing, and not just the type of trade going from physical goods to data, but the implications that has on your need for cheap labor, now not as much, particularly with automation, and then the types of companies that are involved in that. Very different. You almost have to be a global company in order to compete at those highest levels. And then certainly the players. The players are quite different, and you see that transition from Western economies to move to where China is a bigger player in the overall mix of trade. So certainly some interesting perspective on trade and sort of how all of that works together, and how that is not just changing because of the conversation out of Washington and the renegotiation of those deals, but it is also a changed environment in terms of what, in fact, is globally traded. So interesting week this past week, right? All over the map once again was the market. Meanwhile, this earnings story continues to grow. So we talked about this past week being one of the bigger weeks for corporate earnings. It certainly was. The week ahead, we now get into the sort of the tail end of earnings season for the first quarter. And the results continue to be very strong. You've now got over 80% of the companies that have now reported. And what you will find is that earnings growth is in excess of 24%. Meanwhile, the market is just sort of yawning, and sometimes that happens. The reality is, when you look at it from an earnings perspective, really that's a pretty strong number. Other headlines this past week was Elon Musk behaving poorly on a earnings conference call with his Tesla company, and ultimately that caused Tesla to go down quite a bit in value. Also, this past week, Apple announced perhaps one of the biggest share buybacks in history. Apple obviously is one of those companies that's sitting on a lot of cash, and ultimately that cash hoard, or companies with those types of cash hoards, start to get some pressure as to, hey, why don't you do something differently with that money? And one of the options that the company has is to do a share buyback. Now, you may ask, well, what's the big deal with that, and why do I care? The reality is that when you do a share buyback, then you reduce the number of outstanding shares. So ultimately, you take shares off the table. So that means that there's going to be less shares outstanding. If the overall value of your business remains strong and you've got less shares, or there's less people to divide up that value, then what happens? The value of the shares would then go up. Let me put some real numbers on that. So say I had 1,000 shares outstanding. I decided to buy back 10%. That means that there would only be then 900 shares outstanding. Over time, those individual shares would be more valuable because each one of those shares represents a higher proportionate interest of that firm. So those were certainly some of the headlines this past week. As we look ahead, like I said, earnings season starts to wrap up. A bunch of companies this week, a bunch of big names this week to kind of kind of wrap it up, the biggest of which is, of course, our neighbor down the road, Disney. They have their earnings call on Tuesday. So some interesting numbers ahead. I'm sure there'll be a lot of conversation about Avengers Infinity War and things like that, and how that has helped to move Disney's earning. Certainly that movie is making a bunch of money. 2 of my 3 kids have seen it already, and, it's teenage boys. So, Avengers Infinity War really kind of appeals to that age group. So they liked the movie, and certainly there's a lot of people that have, because it's generated a tremendous amount of money. So, but I'm sure we'll hear a lot of that on Tuesday when Disney announces its earnings as well. So, some interesting stuff this past week. Obviously, as we look ahead to next week, beyond just what we know is going to happen, I am sure out of Washington there will be some interesting headlines that we don't expect, much like what happens this past week when Rudy Giuliani basically said that Trump did know about those payments to his friend Stormy Daniels. So anyway, I'm sure more of that is ahead. We've got some other insights and comments on a variety of topics based upon the conversations that we had while we were up in Chicago this past week. So we'll get more into that once we get back from this break. So you're listening to Dollars and Cents. This is Joel Garris of Nelson Financial Planning, celebrating its 34th year in business this past week. We will be back. Yes, very good. We will be back after these messages.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give them a call. It's time to make sense of your dollars.
Welcome back to the program, ladies and gentlemen. Dollars and Cents here on News Radio 102.5 WFLA. This is your host, Joel Garris of Nelson Financial Planning, celebrating this past week its 34th anniversary. It's funny, I was sitting here and listening to the ad, and we run ads for our Monday through Friday business at Nelson Financial Planning. We run ads during the breaks, and was listening to the ad that is obviously raising the question about fees and how that plays out, and it just. One of the interesting trends that has evolved in the financial services industry is this notion of fees and this real focus on fees. And I think what happens for many investors is that causes them to lose perspective on what really matters at the end of the day. It is not how somebody gets paid. It is not how much something costs in isolation. It is really the outcome that you get from that. And we've talked about this topic many times before. The good folks at Vanguard, which arguably has some of the lowest fees, if not the lowest fees in the industry for its mutual funds, in fact, did an analysis and spent a lot of time on the research of this topic to learn that using an advisor, in fact, adds, on average, about 3 full percentage points per year to your investment outcome. Way too much focus is on fee, and not only just fee, but how it gets paid. There's a big conversation in the world, in the financial services world, that talks about fee only. We are fee only. And the suggestion is that anything that is not just fee only is somehow biased advice, which is an unfair suggestion because there are plenty of fee fee-based platforms that, in fact, follow a fiduciary standard by virtue of the designations that an individual holds. For example, certified financial planner is a designation where you commit voluntarily to a fiduciary duty. And might I suggest, if you're committing voluntarily to a fiduciary standard, then perhaps you really mean it rather than the one that is forced to commit to it. But there's this great conversation out there about fee only. Here's the trend that we've observed from the cheap seats as we survey the ballpark of the financial services industry. Fee only is more expensive than many options that you would find for yourself on a fee-based platform. So I encourage you, if you're fee only, and we've actually had conversations with clients that say, well, if you're not fee only, I refuse to do business with you. Be careful. Doesn't matter what you call it. An apple, an orange, whatever it is. It's still a cost to the investor. And it's so important to understand what those costs are. And don't just listen to different parts. And don't let the financial services industry feed you what they want you to believe. Because this push over the past decade to fee only, you know what that actually results in? Results in you paying more. It really does. Look at the numbers, and you'll find something very different on the fee-only side. The fee-only side is becoming very expensive for investors. Doesn't matter what you call it, it's still an investor cost. So let's strip out all of this conversation about fee-only, fee-based, investment advisor, broker-dealer. Just ignore all of the labels. Because the financial services industry is doing a fantastic job at trying to sell you something that at the end of the day, our observation is that it simply winds up costing you more. Look at the numbers. That's what that ad's all about. As I was sitting here listening to the ad, it struck me that is a message that many investors need to understand. Call it an apple. Call it an orange. It's a cost. Call it whatever you want. Okay? A fruit's still a fruit. A cost is still a cost. Package it however you want it. Put lipstick on it. It doesn't matter. Those are not the questions you should be asking. You should not be asking about what vanilla flavor of the fee is. You should be asking, what's my total cost? And not just the cost that you pay the financial services firm, whoever that might be, but also what's the cost of the underlying investment that you're putting me in? Because, see, that's this great movement that the financial services industry has managed to convince the investing public is that, if you just go to a fee-only platform, I assure you, that'll absolutely be the most cost-effective. It's not. We see it all day long. Investment advisory firms, the total cost to the investor is more expensive than many of the more traditional options out there. We encourage you to make a comparison and don't just swallow what the financial services industry has done. They've done that shift for one thing and one thing only, and that is to increase their bottom line in a post-2008 environment. Now, I understand that there's not a lot of people talking about it, and certainly not many talking about it in this form and fashion. But strip all of that nonsense away, and at the end of the day, your bottom line cost as an investor is what's the most important thing to be asking as it relates to fees. However, there is something more important than that, and that's outcome. A BMW runs differently than a Yugo, doesn't it? Just don't look at outcomes. Look at outcomes. Fees are an important consideration, but look at outcomes. Man, I digress completely in that segment. All right, so now I got to reset. Got completely off track. We're going to reset. We're going to take a break. We're going to come back, and I want to continue this conversation about changing trends in society today. We talked a lot about global trade in the first segment of the show. We're going to talk more about some of the demographic changes that are happening as well. So stay tuned for that after the break here on Dollars and Cents. This is Joel Garris on News Radio 102.5 WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Welcome back to the program, ladies and gentlemen. Dollars and Cents. This is Joel Garris of Nelson Financial Planning. You're listening to News Radio 102.5 WFLA. Always remember, from an investing perspective, it's about the bottom line. What's the total amount of something, the cost for the investing approach that I'm using? And that comes in second, though. Second to what the outcome is, right? I mean, because at the end of the day, it's really the outcome, the net result. After all of that is what you're seeking. You want the best possible outcome, the best possible result. And that's the important question to ask. Talking earlier in the program about some of the global trends, and certainly one of the trends here in this country that generated a bit of conversation over the course of the past week or two is that you finally had Treasury yields going above 3%. Now, that doesn't mean that we're now borrowing at 3%. It means that the Treasury yield itself is effectively at 3%. Let me see if I can explain what that means. So the par value or the purchase price of a Treasury is below 100. Normally par value at 100. If you're able to purchase at a discount with the same interest rate, because see, a 10-year Treasury, when it gets issued at a set interest rate. And then the market sort of determines, okay, what is the effective yield of this debt instrument? So as the price goes down, the effective yield goes up. So the price goes down on a U.S. Treasury when there's a lot of demand for it, for example. The people actually want to own U.S. debt. And for that point, it still is one of the most widely owned debts out there by a long shot. And so those numbers ultimately produced a yield above 3%. And that is sort of catches people's attention. What's interesting about that 3% number is that it's significant in that it sort of means that you've had a full economic recovery post-2008 in this country. It really is an underlying gauge or temperature of the economy itself, and it certainly would indicate that things have fully recovered post-2008. And while much of the conversation is over this concern that the Federal Reserve is going to raise interest rates too quick, let's not forget what raising interest rates means economically, which is that the economy is doing better, and so interest rates go up in accordance with that in order to deal with inflation. See, inflation has also risen, and so consequently, you're looking at higher inflation, higher yields, more a reflective of the overall strength of the economy. Now, what's interesting, and this was certainly part of the conversation that we had this past week, is that when you look at the concern over higher interest rates and the effect that that's going to have, it sort of ignores one of the biggest changes that is coming into play for 2018, and that is these tax cuts. And I think one of the things we said last week on the program, maybe it was the week before, whereby analysts had significantly underestimated the value of these tax cuts on the improvement in corporate earnings. Before this earnings season started, corporate earnings were expected to grow at around 15 or 16%. Lo and behold, we're almost all the way through earnings season, and that earnings rate is over 24%. One of the biggest contributors to that difference is the underestimation of the value of these tax cuts. And so with this conversation about interest rates and higher interest rates, I think that ignores the positive economic effect that you would get on from these tax cuts. So ultimately, I think this concern, and this was a concept that was shared with us this past week, the concern over higher interest rates is really counterbalanced by the fact that we see these lower tax rates. So these lower tax rates are in fact serving beyond lowering your taxes and lowering the corporate tax rate. They are in fact serving sort of an unintended but yet positive economic consequence, in that they are helping to offset whatever the economic impact is for those higher interest rates. So an interesting interplay between interest rates, which we know are clearly going up, and the tax cut, which prior to 6 months ago didn't look like it had a chance of happening. But in fact, of course, it has, and that's serving as a very strong counterbalance to whatever the negative economic impact is on higher interest rates. And the reality is that I think we sort of are ignoring a lot of the economic data that has been happening over the course of the past few years as well. And it doesn't matter whether it is the economic data from us, certainly economically in terms of unemployment rate. One of the headlines this past week was that the unemployment rate had gone down to 3.9%. To put it into perspective, that unemployment rate was all the way up to 10% in 2009. That's not just happening here in this country, but also in other places. You hear a lot about the European Union. Their unemployment rate was as high as 11%. Theirs actually peaked in 2011, a couple of years after us, which sort of explains why the U.S. has always kind of been leading out of the economic recovery post-2008, because the folks over in Europe were, in fact, a couple of years behind. Their unemployment did not hit the peak until 2011, but theirs is back down to just over 7%. And so when you start to look at these numbers, you really do see a much greater economic improvement across the board. One other comment on interest rates and the Federal Reserve. You hear a lot about our Federal Reserve. Look, in this country, we have very myopic. Okay, whatever's happening in our country, it clearly has got to be the most important thing. And my goodness, that's what we need to wring our hands about. The Federal Reserve, as it goes through and tries to unwind its balance sheet from all of the stuff that it did post 2008. Oh my goodness, I'm going to start wringing my hands, because our Federal Reserve, they've got so much to do in terms of reducing down their balance sheet. Here's an interesting statistic for you to consider. Out of the 4 primary central banks in the world today. Okay, so that's the U.S. Federal Reserve, it's the European Central Bank, it's the Bank of Japan, and then it's China. Okay, so the four large central banks in the world today. You know who has the smallest balance sheet out of those four? Meaning it's got less debt on it than anybody else in terms of the Federal Reserve balance sheet? It's the U.S. So be careful when you hear this conversation of, oh, my goodness, the Federal Reserve balance sheet is just out of control and it's out of whack. Understand the perspective of where we are relative to the rest of the world. We have our Federal Reserve balance sheet is, in fact, the smallest out of all of those other central banks. Interesting stuff, and certainly not stuff that you hear very regularly in the financial media. They just love to have you wringing your hands over, oh my goodness, the Federal Reserve, they're going to raise rates, they're taking the liquidity out of the market, and oh my goodness, it's just going to be bad. Until you realize that they've got the smallest balance sheet out of any of the four central banks. So we'll slide to a break. We get back from the break, we'll continue the conversation here on Dollars and Cents. I'll probably hit you with a bunch of more random stuff for you to think about here in this last segment. So stay tuned for that here on Dollars and Cents on News Radio 102.5 WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give them a call. It's time to make sense of your dollars.
Welcome back to the program, ladies and gentlemen. Dollars and Cents. My name is Joel Garris, Nelson Financial Planning. But they ran my fee-oriented ad during that last segment once again. Here's the other change, which we've just begun to really digest. You understand that if you're on a fee-only basis as an investor, that those expenses are no longer deductible, right? I mean, you do know that. Because one of the justifications that I've heard in the industry is that, well, you get it as a tax write-off. Well, okay, maybe, subject to a 2% threshold of your gross income. So your fees have got to be pretty high to write it off in the first place. But, okay, let's say it is. You don't get that anymore. So stay tuned. It'd be curious to see how the financial services world plays that one out, because now their fee-only approach isn't have a tax deduction on it. Make sure you're asking all the questions as it relates to investor costs. Don't ask for labels. Ask for total investor costs, not just what you're paying the financial advisor or the financial advisory firm or the wealth management firm or whatever they want to call them. Okay? Still somebody that's supposed to be there to help you with your finances. Make sure you ask not just how much you're paying them, but also what the underlying expenses are of the investments that you own. Some interesting trends that we heard we wanted to kind of share with you. This is going to be our kind of our grab bag segment. 20% of the jobs in America in the next 5 years will be freelance jobs. 20% freelance jobs. That means that you're getting paid generally on a 1099 basis, and that means you've got to make sure that you have done some tax planning along the way. Maybe you've heard this one before, but there are as many millennials as there are baby boomers. The oldest millennial now is age 40. They're starting to grow up, folks. The youngest is age 25. So there's 80 million millennials and 80 million baby boomers. Interestingly, baby boomers are a little bit more interesting than we give them credit for, or at least the media, right? They say the millennials, they're all, But here's the interesting stat. As a boomer, you are twice more likely than a millennial to start a business. Isn't that interesting? Twice as likely to start a business as a boomer. 50% or half of all baby boomers will keep working past retirement age. So certainly a changing demographic, certainly changing population makeup as well. We're becoming a much more heterogeneous in our makeup as a country. That is for sure. And certainly when you look at what's happening over in China, certainly the Chinese economy has been expanding rapidly. And what you have to realize is that if you're looking on the emerging market side of things, you have to be aware just how much exposure to China that gives you. If you look at an emerging markets index, China is effectively 58% of that. So just be careful from an investment perspective on your ownership of an emerging market or an emerging market fund that isn't really at the end of the day all about China, and certainly much more concentrated over in China. That's some certain important things to kind of think about. Similarly with bond yields, we talk about bond yields effectively getting above 3% over the course of the past week, and the issue there is that you have to be very careful of what you actually own on the bond side of things. There are many bond funds, like multi-sector bond funds or bank loan or floating rate bond funds or corporate bond funds or high-yield bond funds that are bond funds, but in fact have a much higher correlation to equities than most people appreciate. So be careful if you're in that sector that what you own is actually a true reflection of the typical performance of a bond and not more of a reflection of the equity markets. Because what a lot of people have done over the past few years is as they've attempted to look at and reach for yield and interest and those kinds of concepts, that many people now find their portfolios in bond funds that aren't your classic bond fund. And so be careful with that, because as you go through and look for those types of yield or that type of income from a retirement perspective, you have to be very careful about the underlying composition of the bond funds you hold. Many bond funds, floating rate funds, corporate funds, and multi-sector funds are, in fact, have a much greater correlation to the equity side. And even on the short-term bond category, what you would say is sort of a true bond fund that would have much less equity correlation. Nearly 90%, 89% of the short-term bond funds that have been behaving the best in terms of interest rate and yield are, in fact, secretly chasing high yield or emerging market or bank loan or corporate bonds. So be very careful. Your short-term bond fund, or at least 90% of them, of the best performing ones, are in fact drifting in terms of the underlying allocation. So if you've been recommended a short-term bond fund because it's got a great yield and that yield is better than the average or better than what you would expect, be very careful about the composition of that fund. The numbers are in, and nearly 90% of those funds are cheating, meaning they're getting their yield by owning stuff that has much more of a correlation to the equity markets than you realize. They're cheating by owning high yield. They're cheating by owning corporates. They're cheating by owning emerging markets. They're cheating by owning bank loan funds. Bottom line is, be careful on your short-term bond fund. There's a lot more cheating in that category of non-equity bond correlated assets more to assets that are more correlated to the equity side. So again, some concepts there that you really want to be thinking about. The music means, though, we have got to wrap her up. So we will wrap it up for this week. We will be back next week. Next week is Mother's Day, isn't it? I think that's right. Yeah, Mother's Day. So we'll have a Mother's Day episode next week here on the program, Dollars and Cents. This is your host, Joel Garris of Nelson Financial Planning. You're listening to News Radio 102.5 WFLA. How have your investments performed over the past 5 years? Do you know? Are you happy with that number? At Nelson Financial Planning, we've been achieving investment results over the past 30 years using actively managed investments that we own personally. This is Joel Garris, and I invite you to review your investment results with us. Visit nelsonfinancialplanning.com or call us today at 407-629-6477 to set up a conversation to review your investment performance. That's nelsonfinancialplanning.com or 407-629-6477 to set up that conversation.
A-plus Better Business Bureau accredited. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services. Member SIPC and FINRA. Listen to Joel Garris on Dollars and Cents every Sunday at 9 a.m. on News Radio 102.5 WFLA. This show is intended for general purposes only, as individual situations may vary. Statements made should not be relied upon as recommendations or solicitation. When discussed, past performance is no guarantee or indication of future results. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services, member FINRA, and SIPC.